You agree with Jim? Is there a place for bonds in your portfolio anymore?
Well, as someone that actually serves as a portfolio manager for a fixed income product, I'm going to say yes, there's always a place for bonds in your portfolio, but you have to be very cognizant of what you're using them for. For the clients at Crossmark that are using fixed income right now, and I will tell you, balanced portfolios are the largest component of the new assets that we see coming in to Crossmark, where they're combining a large cap and a core fixed income portfolio. I mean, you're using it for diversification and you're using it to match your assets and your liabilities. You're not going to get that same benefit out of the equity market. Now, saying that, I do think you have to be careful. You don't go into the fixed income market, at least not in our opinion, and use that as your risky assets where you're trying to really take that risk with high yield. We don't recommend doing that. We like the investment grade, the more core components that you would use with treasuries and agencies, investment grade corporates. So there is a place for fixed income, but I think you have to be very cognizant of what you're using it for and make sure you don't stretch too far down the credit curve where you could get caught. And then something like a Microsoft or an Apple would probably be a better bet.
Okay, so I'm curious, in terms of the bond market right now, what's the best rate you could get on like a tax-free muni that you think isn't gonna have a problem?
Yeah, I mean, it's difficult. When you look at the municipalities that are out there, we buy only A or better municipalities because we're really concerned with the quality of the portfolio. So, I mean, you're not looking at a high percentage. You're looking at something that's going to be less than the S&P yield. And so for a lot of people, going into the equity market makes more sense from a yield perspective. But again, it comes down to what your tax bracket is. It comes down to, are you trying to match liabilities and assets? Are you trying to generate yield? So you really have to look at what your goal is to determine where you're going to be best suited. But again, we're looking at a 10-year that's at a 0.77. You can imagine even going out 5-7 years on corporates or on tax-free munis, you're still only getting a couple percentage points.
Shepard Smith here. Thanks for watching CNBC on YouTube.